Most people debate stocks versus real estate are asking the wrong question entirely. If your goal is truly to provide for your family, not just today, but for generations to come, then we need to talk about something much bigger. We're talking about building a business, specifically starting a hedge fund or a real estate fund. I'm talking about unlocking the kind of potential that could one day put you on a $300 million yacht or that Gulfstream G550 you've dreamed of, if that's what you want. The ability to provide for your children, your grandchildren, and your community on your own terms. And if that's not what you want later on, it's easier to scale down on lifestyle than to build it later on in life when you realize that you need more into retirement years. Now, I'll be honest with you, I don't live that lifestyle yet. I'm not on a jet, I'm not on a yacht, but that's exactly where I want to get to one day. And for that reason, I've spent a significant amount of time studying how real wealth is actually created. However, I can tell you that I was a struggling theater grad that started with nothing. 20 years later, through hard work, I own properties throughout Ontario. But I want to do more than this in life though, so I started doing some research. What I keep finding is the same pattern over and over again. Most people who I researched up that lived in the hundreds of $1 million lifestyle did it by owning or starting a business, not by owning 2 or 5 properties or buying a stock here or there. That said, building a business is one of the hardest things a person can do. Most people will quit. You have to be genuinely hungry for it, obsessed even. But here's what I truly believe. If you're hungry enough, it almost doesn't matter whether you choose stocks or real estate. You will find a way to win. That's why they have a saying, 99% of the population end up working for the 1% that kept going. And that brings me to the most important point in this video. I don't think stocks are better than real estate or vice versa. What I believe is that you need to invest in something you actually enjoy. Whatever pulls you in, whatever you can't stop thinking about, that's the one for you. It's different for every entrepreneur. This video is for educational purposes only. If you are venturing into a new investment, be sure to speak to a licensed professional. Without further ado, let's begin. $7 billion. RBC, BCI, and Quad Real pool that into a single real estate partnership. The person who brought 2 condos in Mississauga wasn't anywhere near that conversation. So what does a $7 billion real estate partnership actually do all day? They source deals across logistics, housing, and commercial assets, and every single deal goes through institutional underwriting before a dollar moves in. When an asset has given up most of its return, RBC and Quad Real sell it, pull the capital out, and push it into the next opportunity. The machine keeps running regardless of what any one property does, because no single property is the point. The platform is the point, and that platform manages the foundation BCI domestic core assets, which now exceeds $27 billion in total. Most people watching this have been playing a totally different game. You find a property, you buy it, you hold it, and you hope it goes up. That's the whole strategy. RBC and Quad Real aren't doing that. They built a platform that earns management fees, spreads out risk across dozens of positions at once, and keeps attracting more capital because the structure itself tells investors it's serious. Institutional money doesn't chase hot assets, it follows credible structures. Brookfield's 2026 investment outlook uses a phrase I want you to remember: disciplined capital recycling. They apply it across logistics, housing, and data infrastructure. What it actually means in plain terms is this: they sell assets once the return has been fully extracted, then redeploy that capital into the next deal. The fund never sits there waiting for appreciation. It's always moving. Now compare that to owning 3 rental properties. If you want to recycle that capital, you have to sell a property, trigger a capital gains tax event, and basically start over from scratch. A fund structure lets you do that continuously, and you're doing it with investor capital, not just your own. That's a completely different engine. The people who got there built a machine, not a portfolio. They started with a structure, built a small track record, and kept pitching until the money showed up. The structure came before the scale every single time. Avenue Living is a case worth knowing. They built a large private real estate fund in Canada and offered investor monthly liquidity, which sounds great until rates rise fast and redemptions started coming in. The underlying properties couldn't be sold fast enough to cover what investors wanted back. So Avenue Living froze redemptions for up to 6 months while evaluating a go public transaction as a REIT on a TSX, just to give investors a real exit. Most people building their first fund don't think about that until redemptions are already hitting. So ensure you go through the particulars with your lawyer during the inception. The $7 billion number isn't the story. The story is that RBC and Quad Real built a machine that sources deals, underwrites them with discipline, manages them actively, and recycles the capital when the return is done. The assets inside the machine are almost secondary to the machine itself. Once you actually see that, you start looking at the host stocks versus real estate debate differently, because neither asset class is the product, the fund is the product. And what the actual 2026 numbers show about those two asset class is not what most people expect. In 2026, RBC data shows that long-term returns from Canadian equities and residential real estate are actually pretty close to each other. And that blows up the real estate always win argument people love to repeat at dinner parties. Most people never see that data, so they keep treating real estate like it's a cheat code and stocks like they're gambling. The reason real estate looked so incredible for so long comes down to one thing: borrowed money. You put 20% down, the whole asset appreciates, and your return on that down payment is massive because you control $1 million asset with $200,000 of your own cash. When Toronto and Vancouver were adding 10% a year and the Bank of Canada rates sat near zero, that math worked almost embarrassingly well. Even sloppy deals looked like a genius because the market was doing the heavy lifting for you. That game is over. The Bank of Canada sits at 2.25% in 2026. That sounds low compared to where it was in 2023, but it's nowhere near the 0.25% world that made aggressive borrowing look risk-free. Debt costs money again, and that changes the math on every deal you underwrite. CMHC's 2026 outlook doesn't sugarcoat it. Slow growth, cooling rental rate markets across the country, and real region gaps that mean the same deal underwrites completely different depending on where you're buying. Home sales in Toronto slipped 11.2% year over year in 2025. Benchmark prices in Toronto dropped 6.3% over that same stretch. So anyone still running 2021 rent growth assumptions on a new Toronto apartment building is going to get burned badly. Calgary is a different story right now, which is exactly the point. A fund manager who tracks those regional differences and adjusts their underwriting accordingly finds opportunities a retail investor never even looks for, because a retail investor is too busy arguing whether real estate beats stock as a category. Stocks in 2026 aren't a sure thing either. After a strong 2025, a forward outlook is more muted, and nobody's promising another big run. But a compounding engine is cleaner than real estate in some real ways. No tenants, no financing cycles, no construction delays, no 2 a.m. calls about a burst pipe in Unit 4. You buy it, compounds, and the only thing that keeps you up at night is your own conviction in the position. So if both asset class carries real risk right now and long-run returns are closer than people think, why does any of this matter to you? Because a retail investor sits inside this debate and just tries to pick the winning side. A fund manager sits outside and asks, what's the deal structure? What's the underwriting standard? And how do I allocate capital efficiently across what's actually working? Those are the questions, and they produce different results. A hedge fund manager running a market-neutral strategy in 2026 doesn't need the market to go up to make money. They go short on sectors that they think are overpriced, long on sectors that they think are undervalued, and the fund earns on a spread between those two positions. A retail stock investor just holds and waits and hopes the index cooperates. One of these approaches works in a flat or choppy market, and one of them doesn't. In 2026, Canadian environment isn't punishing people who picked real estate over stocks or stocks over real estate. It's punishing people who picked the retail approach over the institutional one. When borrowing was cheap and assets ran hot, you could get away without disciplined underwriting. Now, The rate environment has normalized, and the edge belongs to whoever has the tightest deal flow, the most conservative pro formas, and the most disciplined capital allocation process. That's where the actual decision starts, because fund structures you build depends entirely on what kind of business you're actually willing to run. Two completely different businesses sit in front of you, and the one you pick shapes everything that flows. A hedge fund is a financial product business. You raise capital from investors, you deploy it across positions in public markets, and you charge a management fee plus a performance fee on the gains. You don't need a warehouse, a contractor, a property manager. What you need is skill, a track record, and compliance infrastructure that makes investors feel safe handing you their money. Alternate IQ tracks the Canadian hedge fund space across several strategy categories: equity focus, credit focus, market neutral, macro private debt, and private equity, with mortgage funds added as a brand new category starting in 2025. As of September 2025, equity focused funds arranged an 18.18% one-year return, while market neutral funds averaged 2.61 over that same stretch. Same industry, completely different results, because each strategy demands a different kind of expertise on the managers who don't actually have that expertise don't last long. The performance gap matters because a hedge fund has no physical assets sitting underneath it generating cash while you figure things out. If your strategy stops working, investors pull out money and the fund shrinks. There's no building other than the lease you pay for the offices, no tenants writing rent checks, nothing to buy you time. The whole thing runs on your ability to keep producing returns, so you better love the work of finding them. A real estate fund runs on a totally different engine. You're sourcing deals, negotiating financing terms, managing construction timelines, handling tenant risks, and working through Canadian tax rules through capital gains and depreciation. And you're doing all of that at the same time as you're raising capital from investors. It's heavier and slower than a hedge fund, and it's more sensitive to where interest rates sit. But a real estate fund produces something a hedge fund doesn't have in its early years: actual cash flows from rents, and that gives your investors something concrete even when the broader market gets choppy. Kingset Capital runs a good example of how this works at scale. They combine equity investments with debt financing and offer conventional and CHMC financing solutions for Canadian borrowers, so cash flow from the lending side steadies the fund while the equity position captures the upside of appreciation. One side of the business stabilizes the other, and that structure is something you can study and adapt even at a much smaller starting size. Brookfield builds real estate funds around owning and operating, not just owning. Their 2026 outlook puts real weight on what they call essential industrial and business transformation, which means they're buying logistics and industrial assets, managing them actively, improving operations inside the business, refinancing when the rate environment makes sense, and selling once the return has been fully captured. That's the gap between a real estate fund and a landlord who wants to own a few properties. Operational density and capital discipline versus patience and hope. So are you an entrepreneur, or would you rather choose to be working for someone? The core difference lies in ownership versus security. Entrepreneurs embrace risk and uncertainty to build long-term value, while employees tend to seek stability, structured tasks, and consistent income. Entrepreneurs focus on vision, creating systems, and solving problems, whereas employees often focus on execution, optimizing processes, and following directions. Luckily, in this great country we live in, we can choose to be whatever we'd like to become. You may be at a crossroad. Which path will you take? Risk everything to start your own business and create a fund and have the ability to unlock unlimited income? Or are you more comfortable working for someone else but to have stable income? So, here are the 3 things to walk away with. Canadian stocks and real estate produce closer long-term returns than most people think. So arguing about which asset class wins is mostly noise. The fund structure matters more than whatever you put inside it, because the structure is what lets you raise outside capital and manage risk properly. And the fund you build has to be the one you work for free for many years until your business can start to support you. If you enjoyed this video, be sure to watch how wealthy families protect themselves from a lawsuit. Thanks for watching.